Welcome to Module 4, Section 2 and 3 of Women in Finance. Today, we will be discussing the balance sheet and the cash flow statement. So let's get started. The balance sheet is a financial statement which provides a snapshot of a company's financial health at a specific point in time. It has three main sections: assets, liabilities, and equity. Assets include everything that a company owns or has rights to. This includes investments, inventory, property, and equipment. Assets are listed in order of their liquidity, which means how quickly they can be turned into cash. Liabilities covers everything that a company owes to others. This includes loans, accounts payable, and wages owed to employees. Liabilities are listed in order of when they are due, with short-term liabilities listed first. Equities represents the ownership interest in a company. This includes contributed capital, which is money shareholders invested, and retained earnings, which is profits kept for future use. The balance sheet equation is fundamental. The total sum of assets must equal the sum of liabilities and equity. Let's explore some of the categories within assets and liabilities. Firstly, there are current assets, which are assets that can be turned into cash within a year, like inventory. Then there are fixed assets, which are assets that are not up for sale. These include property, plants, and equipment. Current liabilities are those liabilities which are due within a year, such as accounts payable and short-term loans. Long-term liabilities are those that are not due within a year, such as long-term loans and bonds. The balance sheet is therefore a powerful tool because it provides insights into liquidity, solvency, and the ability to generate return. Now let's move on to Section 3, which is the cash flow statement. This is a financial statement that reveals how much cash is flowing in and out of a company over a specific period of time. Let's break it down, starting with operating activities. These are cash flows from a company's core business operations, such as sales, payments to suppliers, and payroll expenses. It tells us about the company's abilities to generate cash from day-to-day operations. Next up is investing activities. These are cash flows related to companies' investments in long-term assets, such as property, plants, equipment, and acquisition of other companies. It includes proceeds from asset sales, showing how much a company is investing in its future growth. Next up is financing activities. These are cash flows related to a company's financing. This includes issuing debt or equity, dividend payments, or debt repayments. This section highlights how a company funds its operations and growth. At the bottom of the statement, we find the net change in cash, which is the overall change in the company's cash balance over the period covered. And with that, we hope that you have a better understanding of the balance sheet and the cash flow statement, two very important financial statements for investors seeking to make informed investing decisions. Until the next lesson, happy investing.